In this example video, we're going to look at review exercises 12-9 and 12-10, which is dealing with recording goodwill as well as looking at what happens if there's impaired goodwill. So they tell us in review exercise 12-9 that our company purchased America's Sweethearts Corporation on January 1st of 2019. And at that time, America's Sweethearts had the following assets and liabilities stated at fair value. And then they tell us that they paid $900,000 for America's Sweethearts. So what goodwill is the difference between the company that we're acquiring's net assets, which are their assets minus their liabilities, and the price that we are paying. So on January 1st, we're going to record what we are acquiring. So we're getting cash at $62,000, and we always record these assets at their fair value. We had accounts receivable in total for $138,000. We had inventory that we are acquiring of $185,000. We have our property, plant, and equipment at a total of $300,000. We also have a patent, and again, it's always recorded at its fair market value of $65,000. And we're going to record goodwill, and we're going to come back to that number in a minute. We also are taking on some of the liabilities. So we have accounts payable that we are now going to be required to pay back of $200,000. We also have our notes payable of $325,000. And remember, they said we paid cash to acquire this company in total of $900,000. So how we do this calculation, we look at the net assets of the business, which are your assets minus your liabilities. So for this business, their total assets that they had were $750,000. Their total liabilities were $525,000. So their net assets are $225,000. Goodwill is calculated based on the difference between the purchase price and the net assets. So we are paying $900,000 for this business, and their net assets are worth $225,000. So that means we have goodwill of $675,000. Goodwill is an intangible asset because the reason why we're willing to pay so much more for this business than what their net assets are worth is because this company has something that's intangible that we want. So maybe that's a certain customer base. Maybe that's a certain location or market share. Whatever that case may be, that's what we're talking about in terms of goodwill. Goodwill is not amortized, but it is tested annually, at least annually, for impairment. So now we're going to look at review exercise 10-9, dealing with this information and talking about impairment. So it says, assume that America's Sweethearts is a reporting unit of Grand Champion, and at the end of 2020, America's Sweethearts has a fair value of $720,000 and a book value of $850,000, which includes any goodwill recorded in review exercise 12-9. Of this fair value, $350,000 is attributable to identifiable assets, net of or identifiable net assets of liabilities. And we need to calculate the impairment loss of goodwill, if any, and record the appropriate journal entry at the end of 2020. So on December 31st, we need to look to see if we have an impairment. So our impairment is going to look at the fair value of the reporting unit minus the book value. So they told us that the fair value of the reporting unit is $720,000 and the book value is $850,000, which means we have a $130,000 impairment loss. So we need to journalize that. We are going to debit our impairment loss on goodwill of $130,000, and we're going to credit our goodwill to bring it down by $130,000.